Hello everyone, in this video I will be talking about the part 1 of topics on risk and return trade-off. So in the in-person lecture last Friday we've covered some topics already. So if you were not in the class for some reason, here are the full version notes. Okay, so you can take a look at it. We talked about cash returns and dollar returns and also the holding period return and the expected return. Okay, so today I will be covering the rest of those notes. Okay, so um, we after we've learned how to measure the return from an investment, the second thing we want to know before we put our money in any investment is what is the level of the risk. Okay, now by talking about risk, we really mean the level of uncertainty. So suppose there are two plans, okay, plan A and plan B. For plan A, in state 1 you get $10, in state B you have $5. And for plan B, either way you lose $5. Now, according to the definition of risk, we would say that plan A is risky, but plan B is risk-free. Okay, so this might sound counterintuitive, but plan B, you always know what's going to happen, so there's no uncertainty going on. It's risk-free. Okay, so having this in mind, the measure we used in finance to measure risk actually relates to the dispersion of the return, right? Relates to the uncertainty of the expected return. So the most common indicator we use are variance and standard deviation. Okay, so the measure for variance, this is the formula. Okay, so it captures the average squared difference between the individual realized return and the expected return. Okay, so what does that mean? So when you calculate variance, okay, so we know that when we're forecasting the future, right? There are several things we forecast. One is what are the different scenarios? Two, if each scenario happens, so what is my potential return? And three, what are the probability for each scenario to happen? Okay, so now to calculate variance, what we do is, so we have our expected return, so that's on average across all the states what we expect. Okay, so that's what we learned last time. If you were not there, go back to the notes. So for the scenario 1, we want to use R1 minus the expected return. So that tells us in scenario 1, how much does it deviate from our average expectation, right? And then we do this for all the scenarios, as we can see over there. And then we want to take the average of those deviation, okay? But now, when we take the deviation, instead of using equal weights, we want to use the probability to weight it, right? So we're giving higher weights to the scenario that is more likely to happen. Okay, so the PB stands for probability. So now we use the deviation times the probability. Okay, and we add up everything. Now the last thing is, why do we have the square here? It's because if we don't have the square, then the positive deviation, the negative deviation is going to cancel out each other. So we don't want that. We wanted to capture the whole the full magnitude of deviation, right? So that's what we take the square, and then all the deviation will be positive ones. Okay. So now standard deviation then is the square root of variance. Okay, so the reason we're using standard deviation is it's easy to interpret, because the variance, it has the square here, so it's not very easy to interpret, okay, as we can see later. So here's an example. So a higher standard deviation or variance indicates a higher risk, because that means on average the possible outcomes deviates from our expected return by a larger magnitude. Okay, so here's an example. Suppose you have the following expectation. There are 4 likely scenarios in the future, and in scenario 1 you're gonna have a negative 3% return, and the probability is 15%, and so on and so forth. Okay, so in order to calculate the variance, the first step is to find your expected return. So that's on average, what do you expect? Okay, so we're gonna take the probability weighted average, right? So we have the return times the probability in the first scenario plus the return times the probability in the second scenario, and we add up everything. Okay, so this number tells us that on average, although sometimes I have negative 3%, some in some scenario I have 6%, but on average, I think my return is going to be 2.65%. Okay, now the variance. Now we're interested in knowing on average how does our potential return deviates from this number, right? So in the first scenario, the deviation is negative 3% minus the average, so negative minus 2.65%. So the net deviation is 5.65%. Okay, and then we take the square just to make it the deviation positive, and then times the probability. So that's the deviation in the first scenario, and then we do this for all the other 3 scenarios. Okay, so we end up with this number that is the variance. Okay, so this variance is not in the same magnitude with the return because we have the square here. Okay, so once we calculate standard deviation by taking the square root of it, we have a number that is 2.7069%. This number is much easier to interpret because it's not at the same magnitude with the return. So the interpretation is that on average, I think my return is going to deviate from my expected return by 2.7069%. Okay. In reality, there are some other ways to measure the expected return and risk, right? So in the previous section, the way we talk about is that we forecast the future, forecast different scenarios. But another way is that instead of forecasting different scenarios, we just look back and whatever happened in the past, we assume that it's going to repeat in the future. Okay, so obviously this one has a huge drawback because the past is not necessarily the same as the future. Oftentimes it's not. Okay, but it's just a very easy way to get things. You don't have to do so many forecasts. Okay, so if we use the past as our basis for the expected return, then the expected return is simply the average of all the past returns. Okay, so suppose you look back 5 years and then you think that's a good representation. So your expected return could also just be the average of the past 5 years annual return. In that case, the standard deviation will simply be the returns in each year minus the average return, and then we take the square and then just divide it by total number of outcome minus 1. So here we're also taking the average, but here as we've seen, it's actually equal weighted average of those deviations. Okay, and note that this part will not be covered in the exam. It's just for your reference. Okay, because this is oftentimes what people do in reality as well. Now, after we've talked about the risk and return, the question is how is the risk and return related? They are related through the required rate of return. Okay, so whenever investors look at an investment, they think about they evaluate the risk. If there's a higher risk with the investment, they require higher return. If they require higher return, they would pay lower risk and lower price, and hopefully by paying lower price, they're getting higher return, right? So that's how things are related and how the asset prices are affected, as we've learned in the previous chapters. So there are several reasons. There are several components in our required rate of return, right? So the question is, what determines how much return you want from an investment? That is basically, there are 3 reasons why you want return. The first reason is the compensation for investors' patience. Okay, so suppose you can purchase, let's say, 5 cups of coffee today. Now, by investing, that means you cannot consume today. You're consuming 1 year later when your investment ends, right? So, but when you consume 1 year later, because as an investor or as human, we always value the current pleasure more compared to the future pleasure, right? So if now I'm going to be satisfied with 5 cups of coffee, then 1 year later I'll be get the same level of satisfaction with maybe 7 or 8 cups of coffee, right? That increase compensates for the patience. So that part we call it real risk-free return. Okay, and then there's this inflation, right? So because today maybe $10 can get us 5 cups of coffee, and 1 year later we need, let's say, $20. So we need to be compensated for that part as well. So that is called expected inflation premium, compensation for expected inflation. So that is when we're standing now and we're thinking about what return we want. So you need to forecast what's going to be the future inflation. Okay, so obviously things could be different from your expectation. So the last part is the risk premium. Risk premium is if you're taking risk. So here, the first two parts, there's no risk associated, but then whenever you invest, there's risk, right? There's this uncertainty, so you want to be compensated for the uncertainty as well. That part is called risk premium. Okay, so if we combine 1 and 3 together, those are also called real rate of return, and that's the real increase in your purchasing power. And this if expected inflation premium is just the illusion of money. You think your money increased, but it's the same amount of products, so your money doesn't actually increase. Okay, so that's the inflation premium. That's why it's some corresponding to the real. This part we can think of it as unreal or elusive. And another way of combining this is that if we take those 1 and 2 together, those are risk-free rate of return because no risk associated. Whenever you put your money in the bank, there's almost no risk, or when you invest in treasury bill, but you still get compensation, right? That comes from the part 1 and part 2. Okay, and the last part is risk premium. Okay, just to help you understand this further, here's a very simple example. Suppose today, you can, with your money, you can buy 5 cups of coffee, and 1 year later, you want 10 cups of coffee. If you choose to invest, right, you get your money back 1 year later. This is what you want to get. Okay, now 2 compensates for the consumption delay because you would be equally happy with 7 cups tomorrow, 1 year later as 5 cups today. And then the other 3 compensates for taking risk. Suppose you're investing in stocks. Okay, investors generally don't like risk, so they want to be compensated. Now the price today for coffee is $2 per cup, and 1 year later it becomes $3. So in this case, our inflation premium, though, so that's our compensation, our required compensation for inflation will be $1. So that's the increase in the price and times the 5 cups. Okay, so that's $5. So we have to have at least $5 more to get the same amount of coffee tomorrow. Okay, so that compensates for inflation. Real risk-free rate of return. So we want 2 cups of coffee as the compensation for patience. So the 2 cups and times $3 a cup 1 year later. So we want $6 additional to cover our consumption delay. Okay, and another part is the risk premium, right? So we need 3 cups and times $3 per cup, so we need additional $9 to compensate for the risk, right? So obviously here we're all using dollar amount. If we transform this into percentage, this is $5 divided by the initial investment $10, so that's 5%, 6%, and 9%. So those are usually what we talk about the premium. Okay, so again, those are ex-ante when you before you invest how much return you want. Okay, and that determines the price you pay today, but the realized return could be very different from what you expect ex-ante. Okay, so here are some definition. Okay, you can read them if you still have confusion about it. Oftentimes in reality, the risk-free rate of return is proxied by the return you can earn from treasury bill, okay, because that's close to risk-free. Okay, so whenever if we think about from stock market, we want 10% return. Question is how much of it is risk premium? Then we use the 10% minus whatever we can expect from treasury bill. Let's say it's 2%, then we say that the 8% is the risk premium. Okay. So here's an example. Suppose you have a real rate of return of 2% and expected inflation of 3%. Risk premium for A and B are 4% and 6% respectively. The question is, what is the risk-free rate of return and what would be your required rate of return from A and B? So here's the answer. The risk-free rate of return will be the real risk rate of return plus the inflation. So that's 5%. Now for A, because you have additional 4% risk premium, that gives you 9%. For B, it's 11%. Okay. Now, the next question is, we're talking about the risk premium. Now, what are the different types of risk investors are faced with? There are a bunch of them. One is the business risk. So when you invest, you worry about the uncertainty associated with the investment's earnings or the investment's ability to pay the return. So if you're buying stocks, you worry if the firm is going to be able to pay the dividend, and you worry if they're going to generate enough earnings to keep the price higher and higher. Okay. The financial risk is the return, the risk associated with a firm's leverage. Okay. So leverage is when firms borrow. So if you have a total asset in the firm of $100, and out of which $50 is borrowed, then the leverage is called 50%. Okay, so that's the debt over the total asset. So the more money a firm borrows, the riskier it would be, because the borrowed money would amplify your potential losses and potential profits. Okay, on both sides. Okay. So here's an example. Suppose think about, there are two scenarios. One is you invest $100, another total $100 out of your own pocket. Another one is you invest $50 and you borrow another 50%. $50. Okay, so in both cases, let's say you make $10 money. In the first case, you would have a 10% return. In the second case, you have $10 profit, but you only invested $50, so that's 20% return, right? So we can see that the by borrowing money, you're amplify your potential return. Okay, obviously it's not totally 20%, because you have to pay the interest as well, because you borrowed money. So let's say you pay $2 interest, but you still end up with 18% return. Okay, so 10% versus 18%. When you make money, you make more. But when you lose money, let's say in both cases you lose $10. In the first case, you invest $100, you lose 10%. In the second case, you lose 20%. Okay, because negative 10% over $50. So you lose 20%. And on top of that, you still have to pay interest. Let's say it's another $2, then that makes your loss to be negative 22%, right? So again, negative 10% versus negative 22%. Okay, so from this simple example, we can see that leverage would potentially amplify your losses and return. Okay, so when you are a businessman, you want to borrow some money, okay, because you're using a little money to do a much larger business, but you also need to be worried about the financial risk associated. Okay, so as a stockholder, we would always are worried if the firm borrows too much, then that's gonna affect our the return of the shareholder. The purchasing power risk is the chance that the anticipated change in the price level would adversely affect the investment return. Okay, so remember we have this expected inflation premium. So that's, if you think the price is going to increase by 2%, then you factor in that into your required rate of return, right? But the purchasing power risk is that, what if tomorrow the inflation turns out to be 5%? Then the required rate of return you initially require or impose on the price you pay might not be enough to compensate for the inflation change. Okay, so that is the risk you're faced with. Or on the other hand, if the actual inflation turns out to be smaller than what you expected, then you're overly compensated. Okay, so those are the uncertainties. Interest rate risk is the chance that the change in the interest rate will affect the security's value. We've learned in the bond chapter that when the market prevailing yield or interest rate goes up, the bond price will go down, and when the interest rate goes down, the price will go up, right? So that's the risk associated with the interest rate change. Liquidity risk is the risk that you might not be able to sell an investment quickly at a reasonable price. Okay, so whenever we invest, our ultimate goal is to increase to be able to have more purchasing power in the future, right? But if you cannot convert the asset you have into real money, then you cannot purchase anything. So if you cannot liquidate your asset very quickly, then that's another risk you're faced with. Okay, you cannot do anything with stocks or real estate. You have to convert them into money or cash. The tax risk is the chance that the Congress will make unfavorable change in the tax laws. So whenever the tax change, that's going to affect our after-tax profits, right? So if this increase, then the money we get to return goes down, and if it goes down, the money we can retain will go up. Okay, so that's another level of uncertainty. Event risk is the chance that something extreme is going to happen to a company that is sudden and substantial. Okay, for example, if you're investing in a firm because you think the CEO is great, you trust him that he is going to make this firm very big in the future. But what if the CEO suddenly dies, or there's a strike against the firm, or things like that? So those are the extreme events that could happen. That's called event risk. Market risk is the risk that is outside the firm. So what if the economy just goes down, or the economy just becomes very good? So those are the outside factors that could potentially affect a particular investment. Okay, so this is a very huge one. So what are the factors that could affect those risks or those inflation or your real risk-free rate of return? There are several two factors. One is called internal characteristics. So those are the factors that's associated with a particular firm, right? If you're investing in Apple, those are the things that related to Apple. So that relates to the type of investment the firm makes, the quality of the firm's management, or how do the firm finance their operation. Okay, so that's what we call the financial risk, right? So that's within a firm. But outside the firm, there are also other factors that could potentially affect your return. For example, the macroeconomic policy, some wars or some price control, political events. Those are the things that happens in the country or in the worldwide that could affect your return. Okay, now so that is all for this chapter. Don't forget to do the quiz on Connect System. I'll see you on Friday.